Hi, good morning, everyone. Thank you for joining us for Phillip Securities Research Morning Call today. Today, we'll be having some stock counter updates, which includes micromechanics results, Frasers, Centrepoint Trust, and CMT and CCT updates, and as well as Sembcorp rights issuance update. Then for macro and sector outlook, we have SG Banking Monthly, SG Technical Outlook, SG Weekly, as well as the Phillip Absolute 10 portfolio update. So without further ado, I'll be starting with the Singapore Banking Monthly. So just an update of the plain numbers from the banks. For 3 months SIBOR and 3 months SOL, interest rates are actually held at 0.41% and 0.21%, which is actually steady throughout the entire third quarter this year between July and August. So even though that the SIBOR and SOL are kind of at historical lows since 2013, we are unlikely to see further downside to the net interest margins from the banks in subsequent quarters because the banks are already starting to monitor their margins, and they are trying to do it through pricing deposits and new loans, as well as cycling off some of the excess liquidity in the system. Secondly, we will be taking a look at the loans growth. Loans growth remains negative in July, which is actually the second consecutive month whereby there was a year-on-year fall in loans. So what we saw was that actually for business loans, we actually saw an uptick from June to grow at 1.48% year-on-year compared to 0.55% in in June. So consumer loans, however, on the other hand, saw negative growth across the board. So every sector within the consumer loans saw negative year-on-year growth. However, what we note is that for credit card loans, it actually grew month on month for the second consecutive month. So from May to June, it was positive, and from June to July was positive as well. So just some news flash for the banking industry. First up is the rating watch negative from Fitch, posing not really a concern for the bank. So Fitch, as we know, the credit rating agency Fitch issued a report, Singapore Bank's limited rating headroom on last Monday, I believe. So within the report, they actually outlined a poorer operating environment, which leads to 3 points: low profitability for the banks, higher credit costs, as well as lower capital ratios, which is your CET1 ratios, capital Tier 1, Tier 2 ratios as well. So, however, all these outlook, they have been actually guided by the banks in the first quarter itself. And actually, the rating watch negative, although it put some doubts over the AA credit rating by the of the 3 local banks, but need to know that actually this rating watch negative was actually in place since April, and just that they are now trying to come out and say the rationale for this rating watch negative, and it doesn't mean that the banks will definitely get downgraded to an A+ rating. It is more of they might not be able to increase the rating, and it might just hold steady. So in our belief, we feel that the banks will likely hold the current rating, and even if worst come to worst, it drops by 1 rating, we feel that the reasons for the fall is not something new, and nothing has fundamentally changed within the industry to be a cause for concerns for investors. Then secondly, we see that actually last week as well, I think in the middle of the week, DBS actually announced that they have gained approval from Chinese authorities to actually enter into a joint venture securities firm with a 51% stake. So we know that doing business in China, you'll require you to go through a joint venture, and as such, they will be able to enter the securities business in China, which seems to be the next hot thing anyway. However, because it is just the start of the announcements, there's no short-term impact because they probably can't operate yet in the near term. They'll probably have to set up the business from ground zero. However, if we think about it in longer term, it might put DBS in a better position for growth in the future. So if we take a look back at the SGX side of things in the banking industry, preliminary securities data actually show that August SDAV, which is the securities daily average value, kind of grew 17% year-on-year in August. So this is good because for the for July and August, even though we see that the markets have kind of stabilized a little bit, we are still seeing a heightened and a sustained more than 10% kind of growth for SDAV for SGX. And however, in the derivatives front, we do see that some of the numbers probably likely to have receded. We don't have the actual numbers from SGX yet. However, if we take a look at the volumes for the top 5 equity index, which contributes to more than 95% of their total equity index futures turnover. In August, all the top 5 equity index futures actually fell 12% in terms of their turnover volume. Yeah, so we are likely to see the actual stats to be slightly lower for the derivative side of things. However, what we do want to note is that what we are having a close watch on actually is the FTSE Taiwan Index Futures, which is actually rolled out end of last month and end of July, sorry. And for the month of August, they actually had quite a stellar set of results. So for the month of August, their turnover was about 350,000 contracts, which kind of offsets the volume of the fall in MSCI Taiwan Index Futures. So the MSCI Taiwan Index Futures fell by 338K month on month, so from July to August. But because the FTSE counterpart, the new product actually offsets it for 350,000, so it leads us to believe that people are viewing this FTSE Taiwan Index as a very good substitute for the MSCI that will be expiring next February. And subsequently, when we already know that SGX is in talks with FTSE to come up with more substitute products to replace their current MSCI suite of products, we feel that actually the impact as a result of the MSCI licensing agreement termination in next February will probably not have a very big impact on even not any impact at all to SGX. So overall, for the banking industry, we are still maintaining a neutral call with an accumulate call across the 3 banks. Even for SGX, I think it's still an accumulate call as well. We already know that within the industry itself, the interest rates will continue to stay low for probably quite a long period of time. And this will continue to weigh in on the net interest margins. But the worst is probably over for the banking industry, just that the recovery will be quite gradual. And all this recovery will come from the resumption of business activities, which will be lifting the non-interest income. So definitely fee income will start to go up. You'll probably see credit card fees start to go upwards and wealth management fee also going upwards. So that is what our expectation for the industry is. And we think that the road to recovery will be long, but the worst is already over. So I'll now pass time on over to Natalie.
Good morning, everyone. So today I'll be talking about Frasers Centrepoint Trust, as well as a quick update on the proposed merger between CapitaLand Commercial Trust and CapitaLand Mall Trust. So starting off first with FCT. FCT announced last Friday the proposed acquisition of the remaining 63.1% stake in Asia Retail Funds Limited, ARF for short, for $1,057 million. So as a quick recap, ARF holds 5 suburban retail malls, which are Tiong Bahru Plaza, White Sands, Hougang Mall, Century Square, as well as Tampines 1, and one office property, Central Plaza. So Central Plaza is located just beside Tiong Bahru Plaza. This is the final step in FCT's strategy to get full control and attain tax transparency for their assets. For reference, ARF paid $12.7 million in corporate taxes for FY19. So this is a potential savings, or rather tax savings, that FCT will benefit from onboarding all of these assets onto their portfolio. This proposed acquisition will be partially funded through the issuance of 628 million new units, and this will enlarge the share base by about 56%. The new units will be offered by way of private placement as well as preferential offering. Also, together with this announcement, they also announced the divestment of Bedok Point for $108 million and an exit yield of 2.5%. So the proceeds from this sale will be used to par down the debt. Over here, we're just showing the existing FCT's existing portfolio, as well as the ARF's assets. So in the red boxes, this is the existing FCT's existing assets. So these are suburban malls located in the heartland areas and very close to transportation nodes. So these malls are located within 1 to 3 minutes walk away from the MRT stations and the bus interchanges. And FCT's portfolio of the 5 retail assets also bears very similar characteristics to FCT's portfolio. So in the purple dotted boxes, these are ARF's assets that will be onboarded, also located near the MRT stations, 1 to 3 minute walk. So this acquisition will actually increase FCT's exposure to the resilient suburban mall asset class. So of course, if you can see in the figure on the left, this is FCT's tenant sales for the past up to July. And in the month of July, you can see that tenant sales are almost at pre-COVID levels, to just 3% down from the normalized levels. And this recovery in tenant sales is despite the density control measures or the capacity constraints restrictions in place at the malls. So tenant sales recovered to almost pre-COVID levels, despite shopper traffic being down by about 30 to 40%. Similarly, if we look at the tenant sales and shopper traffic for the ARF malls, we can see a very similar trend. Tenant sales just 0.7% down from normalized levels, although the shopper traffic is down by about 40% for the month of July. So part of the attractiveness of suburban retail malls stems from the resilience of the recurring necessity spending that occurs at these suburban malls. We saw this during the circuit breaker period, as well as the very strong recovery post lifting of the lockdown. About 53.6% of the tenants are actually operating within the essential services sectors, and this provides recurring necessity spending. Additionally, the acquisition of this proposed acquisition will diversify revenue and reduce asset concentration risk. So you can see in the pie chart on the left that Causeway Point previously contributed or accounted for almost 30% of the AUM, but post acquisition and post transactions, the asset risk from Causeway Point will be reduced to about 22%. So we do like this acquisition, or this proposed acquisition. So we adjusted our forecast to incorporate the acquisition of ARF as well as the disposal of Bedok Mall. So just some color on our estimates. Previously, we forecasted about 7.7% of FY20 DPU, distributable earnings to be retained in FY20 and dispersed in FY21. However, given the sustained recovery, we forecasted we reversed this forecast, and we now think that FCT will be able to disperse all of FY20's distributable earnings in this year within FY20. So this proposed acquisition will be subject to a EGM, which will happen on the 28th of September. And because FCT's financial year end is 30th September, the acquisition and the proposed acquisition and the divestment of Bedok Mall will only happen after FY20. So it will happen in the following financial year, and it will start to contribute only in FY21. However, because we now shifted some of we lowered the FY21 DPU as we released the 7.7% of distributable earnings previously retained. This resulted in a lower DPU for FY21. It was lower by about 1.4%, while FY20 DPU was raised by 12.3% due to the release of the retained amount. So our DPU for FY22 to FY24 was increased by about 2.9% to 3.7% due to the accretive acquisition proposed. DPU yield for FCT for FY20 and FY21 stands at 4.2% and 5.2% respectively. And the last chart from me for FCT would be Transaction, FCT will be the 12th largest S-REIT by market capitalization, but after post-acquisition or post-transaction, FCT will be the 8th largest S-REIT in Singapore. So this will increase FCT's scale and visibility amongst the S-REITs. Okay, so moving on to CMT and CCT's proposed merger. So they also announced a quick update on this proposed merger transaction on Friday. So what's new is that they've extended the long stop date from 30th of September by 2 months to now 30th November. And they also announced EGM that will be happening, the new dates for the EGM, which will take place on the 29th of September. Lastly, the CMT manager also announced that they will be waiving the acquisition fee for this proposed merger. So typically the acquisition fee is about 1% of the total asset value. And the waiving of this acquisition fee will result in $111 million worth of savings. The images below just basically rehashes the deal mechanics. For a CCT unit holder, one CCT share will be exchanged into 0.72 CMT shares, and the unit holder will receive 25.9 cents per CCT share. And here's the updated merger timeline. So the new EGM date, as mentioned, will be 29 September for both CCT as well as CMT, with the extension of the long stop date being pushed 2 months down to 30th of November. That's all for me. I'll pass the time on to Wei Ren.
Right, thank you, Natalie, for your sharing. So today I'll just talk on about the Sembcorp technical look through the SDI and then a few more stocks that we have been sharing. Right, so first up, Straits Times Index on the weekly chart, we can see that the 5 wave has been completed. The third and fourth wave has been completed after price has already broke out the ascending channel. And from that, it's like a continuation of last week. Last week I shared that price is likely to be supported at 2,500 support level. But however, as time goes by, as the support level has been continuously being tested, and therefore it weakened the support level actually. So should 2005 be broken, the Straits Times Index will see the low being tested at 32346 in the near midterm. All right, next one. For the daily chart shows 2 potential support zones. Despite the SDR breaking out of the bearish flag, the index is currently ranging with price actually being supported at 2005, which I mentioned earlier on the weekly chart. After a brief attempt, and then last Friday, we saw a bullish candle appearing. And then as of now, I think price is also on the upside, but it still fails to close above the last Thursday low. So despite that, I think even there is a bullish rebound in the next few periods or next few days, I think the rebound will be small, and then will be kept below at 2580 to 2600. Okay, so moving forward, we maintain the outlook of SDI testing support zone 1, and long-term rebound is kept at support zone from 2,200. 2,208.42 to $2,263 points. Okay, so I move on to the reverse the stocks counter. So for reverse zone, the daily chart as predicted that we predict that there'll be a strong correction downside. Price actually find some comfort in aging upside after prices close above the support with a small bullish candle. Currently, I think price is currently on the upside now, but in the longer run, from the mid to long term, I think price is gonna do a complex corrective flat for now, and then unless this price is broken strongly, otherwise we see that there will be a correction to the downside before resumption of the upside actually. All right. So for Frasers Centrepoint, it's quite a darling of the stocks, despite the stock being supported over here, multiple times, which actually we're gonna support. Actually, the best thing is after July, in August, in late July, after we issued a report in early July, prices actually finally broke the resistance level at 2.4966 in August, which is last month, I think mid-August. And then subsequently it carried on and then tested a new resistance at 2.63. Currently, I think the stock has already break new high after a strong bullish candle above 200 MA and support. So the stock will actually kind of like testing the new resistance zone over here. So once price at here, there will be some selling reaction, and then before resuming back to $3 region. All right. So lastly, for that, for my side, CapitaLand. So CapitaLand diamond pattern and bearish corrective flag is pointing towards a temporary rally. As of now, I think the price is having a slight bullish upward side, but there is some sort of lack of momentum for now. But however, due to the wave, I think the whole CapitaLand is on a bearish downside. Why do I say that? Because of 1, 2, 3, 4, and 5. So these are 5 subwave impulse of the primary phase. And then we have WXY. So the potential regular flat is actually starting from April here instead of mid-May to June. There's an error over here, so pardon me. So A and B wave or 3 subwave has been completed. So we are looking at 5 subwave up to test a resistance zone at 123.6 at $3.37. And then after that, subsequently, there will be a strong correction downward. All right, with that, I'll end off my presentation. I'll pass my time to Paul. Thank you very much.
Thank you, Warren. Move on to the fourth quarter 20 results for micromechanics. Okay, and for those who are not familiar with micromechanics, there are basically 2 parts to the semiconductor supply chain. Firstly, you have the front end. If you recall, we used to have a company called Chartered Semiconductor. So what front end means, they basically produce the wafers in a wafer fab. And then there is the back end, which is where micromechanics is involved in. So what micromechanics does is that once these wafers are produced, there are little dies on the wafer, and micromechanics will provide the rubber tips that will come and pick these wafer dies and then place it for packaging of these wafer dies. So it's a very challenging business, because firstly, these rubber tips have to be very precise, and at the same time, you need a lot of material science so that this does not kind of react to the wafer dies and then cause some electrostatic discharge. And also, you have to avoid contamination, because all these wafer dies are the size of smaller than your fingernail in terms of the dimensions and size. Okay, anyway, we'll just move on. In terms of the positive of the results, I think firstly, if you look at the revenue, was up 15%. It's positive in the sense that there were some disruptions, as you all know, in the June quarter. In Malaysia, you can see from the first bullet point, the staff levels were down to 25% of capacity in April and May. So they did well even despite the disruptions to production, not only in Malaysia, but also in the US. The other positive was gross margins expanded. Gross margins were at 55% and up 3 percentage points year on year. And this is the highest in actually 7 quarters. And the other positive point is the dividends. So if you look at the dividends, there are 2 parts actually, final and special. Not sure why they call it special, because it's already 5 years of special, more like normal dividends. But anyway, combined, they will raise about 17%. But on a full year basis, the dividends for micromechanics is up 20% to 12 cents. So at the current price, they are paying you an impressive 5.5% dividend yield. Anyway, we are upbeat on micromechanics for 2 reasons. Firstly, there are 2 growth drivers. What we see is there is a recovery in the whole semiconductor cycle. What we do use is that we use the back-end semiconductor units volume. When you look at some of these semiconductor industry association numbers, these are sales and include selling price, which may not be so applicable for micromechanics. So we try to gauge more on the unit volumes. And we'll show you later on the slide that the current cycle the growth cycle only started in September, only 10 months. And the typical cycle is about 33 months. The second reason why we're positive on micromechanics is their US operations. I think it's finally penetrated the front end. So in their most recent results, they announced that, that they've been qualified by a new project for a family of ultra-critical parts. Obviously, they are not disclosing much more, but this is the first time they're mentioning, and we're assuming that this is a rather large project, number one. And number two, more important, they are actually penetrated the front end or wafer fab process, which is even higher margins, and the market size is larger, and also the technological barrier is even higher. So we upgrade our micromechanics from a neutral to a buy. For again, the two reasons, the semiconductor volume upcycle, and also a penetration of a new customer and a new business segment. In terms of our, it also pays an impressive 5.5% dividend yield, and with a net cash of 20 million and unleveraged ROE of 25%. Okay, anyway, these are just two charts to highlight our bullet points. So you can see on the left, the typical growth cycle. Of course, growth may accelerate and decelerate, but you just look at months where there's growth, it averages about 33, and we've only about 10 months right now. And how we got into our target price of 250. So there is no direct comparable to micromechanics. So what we do use is the whole back-end semiconductor supply chain. And more applicable for them will be the equipment makers. As you can see, the ROEs, the margins are more comparable, and even equipment makers also do supply consumable. So as a result, we're using about 18 times PE, which is, you can see from the table, the sector is trading about 18 times forward. If we move on to our Singapore weekly, anyway, in terms of as usual, we will highlight some of the key macro events last week. So for Singapore, we had supermarket sales. So supermarket sales, which is important for, of course, the listed Sheng Siong. So you can see that in July, supermarket sales was up 28% year on year. There are two important parts to this. Firstly, it gives us a quick look into the third quarter. As you know, Sheng Siong already released their June results. So this is the first time we can get a peek into how their third quarter is performing. And obviously the numbers look good. It can grow at 28%. And the second point is that, just to give you some perspective how large this number is, I think in 2019, supermarket sales was down 1%. And in a typical year, they move maybe 2 percentage points, 3 percentage points. So that is actually a huge move, the 28% jump. The other point was just the whole macro industry in the whole of Singapore. Retail sales were up 7.7%, were down, 7.7%. But interestingly, furniture sales was up almost 10%. I'm not sure who are those that are buying. But anyway, more importantly for the retail sales is the month-on-month. It's not on the table, on the chart here. But what you can, on the table here, what you can say is that it is up about 24% month-on-month in July, and also up almost 30% in June. So we are getting a so-called V-shaped rebound in retail sales from the very troughs in April. The other big important number was probably the PMIs. So you can see that on the electronics PMI for Singapore was about 50.6, and this is the highest read in almost 2 years. And also, if you look at the next bullet point, which is the global PMI or manufacturing surveys, you can see that globally things are on the recovery track, and also the number that came out was the highest in 21 months. If we look into the US, we do see a steady pace of recovery for the US. Earlier, we had some good housing starts numbers, and right now we look at the job numbers definitely rebounding in the US. So the unemployment rate is 8%. It's off it's lower than the 10.2% that we experienced the prior month. And also payrolls continue to rise about 1.3 million in August. In payrolls in the past used to only move about 300,000, but this is a big number, 1.3. We'll show you more on our charts later. In terms of our technical views, obviously global growth is on the mend, and we are more positive on cyclical stocks such as commodities, electronics, and of course, also for the US office REITs that are listed in Singapore. Because if you see unemployment rate improving, payrolls rising, obviously it's good for the whole office sector in the US. In terms of news of vaccine, obviously any news of vaccine is going to be positive for the market. And if you look at Monkev, I think he is the head of vaccine program in the US. So what he says is that he's expecting a vaccine by year end. And by middle of 2021, he's actually expecting to immunize the whole of US population. This is important, obviously. I think if there is a vaccine, it will be positive for the markets as a whole, and it will actually nudge some of those sectors that have been the worst hit. I know, like your hospitality and air transport. In terms of the fiscal, another important point would be the fiscal stimulus talks in the US between the Democrats and Republicans. It's still deadlocked, and of course, if this deal doesn't happen, it'll be negative for the market. But I think everyone wants a stimulus plan, and the key deadline will be end September. That will be the same timeline where the US has to negotiate on. Every year they do this, where they have to try and negotiate higher the so-called debt ceiling. In terms of corporate news, we'll discuss later the Sembcorp Industries and Sembcorp Marine deal. And of course, we'll just give you an update, the more recent data point coming out for taxi takings, as we have a buy on ComfortDelGro. In terms of some of the weeks, what is happening for the weeks, I mean, those two, the foreign exchange CPI, so that's actually some macro numbers, but as usual, we have some poems webinar by listed companies. So do sign up. I think we have 6 to 7. So do sign up. Just go to the poems and look for the events and seminar page, and you can just sign up for this Zoom event where you can even ask questions, or you can post questions to management. And also these poems webinars where the company will actually give you some basic background of the company. If we move on to our usual weekly COVID watch, I mean, every week we have to do this COVID watch. I guess the not so good news is that the world numbers continue to rise. I think you can see from the blue chart, it's still hitting a new highs. Of course, it's no longer as steep as in the past, but I guess it's not great that we have another new daily high in terms of new COVID cases. The positive is, at least in the US, the number of new cases is actually continuing to drop off. The table on the right is just a reminder that second waves do happen. As you can look from the red line, the Italian numbers used to peak at 5,000 plus. Then it troughed about 200-300. Then right now it moved back to about 1,000, 1,003. So that's not good, but I guess just a reminder that second waves do happen. Again, back to Singapore. Important is the community cases. So what we eyeball more important is the red line, which is the 7-day moving average. So you can see that in Singapore, the community cases are starting to taper down between sometimes 2, sometimes 3 in terms of the weekly numbers. So this is important. And as the numbers continue to dwindle down, we expect phase 2 lockdown to ease, and hopefully we can even move into a phase 3. This one will be very quick. I think just to illustrate, I think we all know there's a big V-shaped recovery, not only in Singapore, the table on the left, but also the chart on the right. You can see there's a V-shaped recovery in terms of manufacturing activity globally. If you look at the chart on the left, right now the unemployment rate in the US is 8.4. It's still obviously very high, but again, it's off the 14.7 just a couple of months ago, and is below even the GFC levels, the peak GFC levels. So you can see that the jobs in the US are returning very fast. The chart on the right is the payroll numbers. These are payroll, the non-farm payroll. So these are anyone in the private sector and government sector that have secured a job, the net numbers. So you can see that during the peak of the pandemic, the US lost almost 22 million jobs from March to April. But what has happened is starting to pick up and actually recovered almost half of the jobs, that 10.6 million jobs. And in August, as you can see, we got secured 1.3 million, which is a really huge number. I think considering that prior to COVID, the usual job growth is about around 200,000. And we just got some data point for LTA on terms of taxi numbers. So the chart on the left just shows the taxi, how many kilometers the taxis are traveling. Obviously, the more the better. So you can see there's a V-shaped recovery. Although the taxi travel is still down 24%, but we can see that there's a V-shaped rebound, and hopefully they can move back up to that 180 level kilometers traveled for one shift. And then at least we're back to the pre-COVID levels. The chart on the right, it just shows a comfort taxi market share. And just a reminder that there are very few industries in Singapore, at least, where any company can actually have at least 60% market share in the industry. But do note that the longer term challenge is, of course, the the Singapore taxi fleet for Comfort, even though they have 60% or more market share, the taxi fleet is still falling and it fell about 11%. So that remains a challenge in the background. Okay, and as usual, we will go through our every month end our Phillip Absolute 10, which is our model portfolio of 10 stocks. So just a reminder, these are our 10 stocks where we allocate a 10% weighting to each stock. Then every month end, we will rebalance it back to 10%. Again, this is just to compute performance. And this purely for illustration, it excludes the monthly rebalancing cost. You know, as you buy and sell, there could be some bid-ask spread. And also the transaction fee, the brokerage fee, which is pretty low these days, as we all know. And also, and on the flip side, it also excludes the dividend income. As you can see, this portfolio on paper at least enjoys a 5% dividend yield. But of course, we will just assume that that is offset against the transaction fees. So we were up at the bottom on the table on the left. You can see that for the month, at least we're up 3.15%. That small little table on the bottom is basically the monthly performance compared to the STI. So we of course, by far, we kind of outperform the STI. But again, our purpose is to give, as the name implies, no, absolute 10 is to try to generate absolute returns rather than relative returns. So in terms of just a quick comment, the table on the right-hand side is just the performance of the various sectors in Singapore last month. So you can see that you can look at the industrials-electronics. So last month, this is one of the better performing sectors. Industrial was up 6%, and the other one was transportation. So the cyclical industries, I think, did well in August. Worst hit was the commodities, which was down, I think, minus 3%, 5%. I think this is mainly because of Wilmar and some of the company-specific events. Okay, anyway, we'll move on. We've been getting quite a bit of questions on Sembcorp Industries demerger. This chart was actually done in June, and I think we will just refresh and just update a little bit. Anyway, just I know it's quite a complex chart, but just to give everyone just we'll just try to elaborate slowly on how this chart works. So the table on the right, you see, is SMM. So what it means is that before the rights issue, you know, there are two parts to this deal. There's part one, the rights issue, then part two, the demerger. So demerger means SCI, as you can see from the little table on the left side, SCI has about 60.9% stake in SMM. So then part one, they will take the rights issue by converting their loan, the subordinate loan that they handed over to Sembcorp Marine. So that's part one. They convert it to shares. Then SCI say, hey, I don't want I want to demerge, I guess. I want to give back the Sembcorp Marine shares to my existing shareholders. So you can see it from the table on the right, they are no longer a 60.9% shareholder, and they gave back all these shares to Sembcorp Industries shareholders, which is the table on the bottom, but you can ignore that part first. So you can see that part three, what happened is that SCI no longer a shareholder of Sembcorp Sembcorp Marine. You can see there's a dash line. And what has happened now is that Temasek now has become a shareholder, about 30%. And in the red box at the bottom, SCI Public. So these are the Sembcorp Industries minority shareholders. So they've now become the new shareholders with almost around 30.9% stake. And that is the risk that investors face, because what will happen is, as you can see from the bullet point on the bottom right, once the X date happened on 9 September, every Sembcorp Industry shareholder will receive roughly 4.27 Sembcorp Marine shares at that point at 19.7 cents. 19.7 cents was last Friday's close. So what it means is that on paper, at least, every Sembcorp Industry shareholder that holds one share will receive 4.27 SMM shares. No, on paper is free. So what you worry is there's a risk that they will sell, and this 13.9% stake in SMM is on paper at least captive sellers, in the sense that they virtually kind of got their shares free, number one, and also they may not actually want to have a direct stake in Sembcorp Marine and may decide to sell. So that's the risk that Sembcorp Marine will face. This whole huge block of how many, maybe 3.8 billion shares. And then moving back to the SCI chip entry, that bullet point. So what we're also trying to, the other point we want to share is that if you receive this Sembcorp Marine shares at 84 cents and you strip it out against the Sembcorp Industries share price of 194, so that 194 less 84, the existing value of Sembcorp Industries will then be on paper at least 110. And if you look at the book value of Sembcorp Industries after the demerger of Sembcorp Marine, the value that was in the prospectus was about 173. So it's trading about the book value is 173. So it's trading about 0.6 times price to NTA, because the book value is 173. So it looks pretty cheap in that sense. And just one last bullet point, the shares will be credited into the account on 11th September. I mean the Sembcorp Industry shareholders account. Anyway, that's it for our webinar. Thank you for joining us and hope to see you next week.